Hello, everyone. Welcome back for another Fratarcangeli Friday market update. Great to see you all again. And here we are ending the week with our third day of a government shutdown, something that we were hoping we were not going to have to deal with. But I believe that the market has shown resilience once again. We see that the market historically, we're more focused on when the government shut down, how many days, market days that is, that we're going to have this shutdown. And the average has been somewhere between 22 days and less than a week. And we expect this to be somewhere in that lower end range. Roughly 10 days is what the market is predicting. And as it continues on, we may get some more reaction in the marketplace relative to negative performance. But so far this week, it's been a non event, and the market continues to grind higher. And I know that we're in the latter half of the Jewish holiday, Yom Kippur, so wishing everybody a safe and healthy holiday season. But we know that the volumes are low this week as well. So that could be part of the factors. We also know that the data that we're going to be receiving, expecting to be receiving, for example, this Friday's non-farm payroll reports are not going to be coming through. So really, we're flying blind relative to some of the data points that we'd be expecting. We're looking a little closer at the ADP report that came out lower than expected. As a matter of fact, negative job reports as opposed to the positive reading that we were expecting. And what that really means is that later this month in October, with the Fed reporting, we would expect that the Fed will be lowering interest rates once in October and then again in December, which is what was predicted in our last meeting that the Fed Governor Jerome Powell had reported. So that being said, I think that data that we did receive on Wednesday, as well as the data that we've received recently, really tends to lead towards the lower interest rates anticipation on the Fed fund rate that I think the market is receiving very positively. And so we'll keep a close eye on that. Some of the potential impacts in regards to the government shutdown with the cabinet for our current president not being able to get many of the seats filled due to the lack of approval. Now, with the government shutdown, we can see some of those approvals going through much quicker as well. Some of the non-essential government jobs. This is an opportunity for the current regime to come in and shut down some of those jobs, as I know cost cutting is a major topic in our budget this year, and I think for the years to come, with our deficit growing exponentially. So there's some things that we're watching for that I think the market might receive positive. I will say, I think the length of this shutdown is something that we have to watch closely and understand that they need 7 votes on the Democratic side of the House and the Senate in order to approve this debt ceiling approval, an increase. And we do have 3 Democrats that did vote for the actual government bill to be passed, so the shutdown wouldn't happen. So they need 4 more votes. So there's a lot of optimism that this will eventually pass through, and we'll get beyond this and head into the fourth quarter of the year and look at third quarter earnings, as well as what we're hoping for to be a rally towards the end of the year like we've seen historically. On the heels of the September month, which is historically the September slump, it's been a month of volatility and negative performance for the last decade. This will actually go down as one of the best September performances in the markets here domestically, specifically the S&P 500, going up 3.5% this month. And like I said, closing out to be one of the best Septembers for the last decade. So some momentum building in the marketplace. And I think the anticipated earnings growth, not only for the remaining part of this year, but also going into next year, I think there's some optimism out there. And so we have to keep our eyes on the data that we've received recently and understanding what our objectives are relative to our long-term portfolios, and possibly take advantage of locking in some interest rates for our shorter term, call it cash reserves, with the anticipation that rates are going to drop in the next, call it, meeting in October as well as September, which means our money market rates will go down simultaneously. So the interest we're making will be affected. And we may want to consider buying a 3-year treasury or a 6-month treasury for some of our shorter term capital needs, but yet lock in the interest rate. We also know that those lower interest rates will have a positive impact, ideally for the longer term interest rates, which will spike in some momentum in real estate for folks out there that are contemplating getting some type of a longer term mortgage, that right now rates have been elevated since 2022. So we're looking for some positive aspects to the interest rate environment coming down and the impact that it has on short-term interest rates as well as anticipated long-term interest rates. I will also remind everybody that the power of compounding, the power of our money working for us year over year over year. We don't want to be caught up in the short-term volatility when our objectives are on the long term. And so let's make sure that we pay attention to what Albert Einstein calls the eighth wonder of the world, which is the power of compounding, and making sure that we don't get caught up on some of the short-term volatility that I believe will be here soon enough. And we want to maintain our focus on the long term. So I thank you all for joining me. I look forward to seeing you soon, and be well and have a wonderful weekend. Bye for now.